Having this mindset that we don't do any continuation funds or we do all continuation funds may have worked in the early days as a simple response. It really doesn't work today. The reality is they're not going to say, oh, I'm doing this because I am not going to make carry in this fund. You're trying to evaluate not just the CV, but what does the portfolio look like that's been left behind. Smart GPs are going to be full disclosure and information and give folks time.
Hi, everyone. Thank you for tuning in to another episode of Women of Secondaries, produced by SecLink and hosted by yours truly. My name is Kristina Kulikova. I'm the Senior VP of LP Advisory at Setter Capital, and I'm absolutely privileged to host Women of Secondaries, where we cast light on the incredible powerhouse women driving this market. If you missed our prior episodes, make sure to check them out on the SecLink video and podcast section, YouTube, Spotify, or catch short snippets of the discussion on the SecLink's LinkedIn page. On today's episode, I'm so excited to have an extremely versatile individual who has worn many hats throughout her 20-plus year career in capital markets, including her LP hat as a partner and head of fund investments at a leading Chicago-based money manager, where she spent 15-plus years overseeing both primary and secondary investment portfolios. This industry veteran has sat on numerous reputable GP advisory boards and is no stranger to being the VP guest at panels and other speaking engagements. It's also very interesting to have an LP perspective on the show, as we have had buy-side firms, legal firms, and advisory firms on the show, but not yet a limited partner, particularly one who herself has participated in structuring of numerous secondary transactions. With that, I'm very glad to welcome truly an industry titan and a tenured professional, Claudia Baron. Welcome, Claudia.
Thank you, Kristina. I really appreciate participating in the podcast and sharing my views of one LP's perspective of the secondary market. As you said, I've been in the PE world for probably longer than I want to acknowledge, 20 plus years. That included, investing in primaries, secondaries, doing some secondary transactions, being on GP advisory boards, sitting on industry panels like ILPA, being involved in industry organizations, and chairing different committees within ILPA. So I'm very excited. I come from also an operational background, and earlier in my career, I was a chief executive and a general manager of a winery in Northern California. I did a turnaround on that business and sold it for the owners. I was the chief financial officer of a technology company. So that's a little bit about my background. Personally, I grew up in the Midwest, although I live in California today. I grew up in Detroit, very excited about how that city has recovered and flourished. And I went to the University of Michigan, and I am a huge Wolverine fan. So I'm excited to give my view of the secondary market from an LP's point of view.
No, that's amazing. And honestly, being so versatile, I think in all areas of finance, right, really gives you the holistic perspective of looking at the secondary market, which we really haven't, and particularly for me, coming from an advisory view, it's not often we get to hear the sort of raw perspective of an LP when we're talking about either investing into secondaries or the inner workings of kind of how you might view the secondary market. And so I guess, the market has definitely evolved rapidly. But as we mentioned, you're no stranger to investing into secondaries as an allocator early on and also tapping the secondary market for portfolio management. Could you walk our audience through what was your first touch point with the secondary market?
I think our first touch point was right after the GFC, when we looked at the market and said, wow, this is a great time for secondaries, and we made a commitment to a large secondary fund. And to that point, we had really done nothing for our clients in secondaries. And at that point, we educated ourselves on secondaries, and at the same time, we were doing a deep dive on the portfolio and realized that secondaries could be an important part of our portfolio design, development, management. And soon after reviewing that portfolio, realized that there were some managers that were in our portfolio that were not core anymore, and that I had recommended that we shed those exposures. Traditionally, we had just held everything for the life of the fund, which has gotten longer and longer over time. And so I recommended that we shed those positions. And that's when we started talking to a few groups, including Setter, about, possibly transacting in some of those non-core managers. And those were probably our first, one-off position sales, and then actually buying a couple of positions. But that led to a more structured transaction down the road.
Wow. So really touch points, and experience investing in secondaries, selling and buying in the market. So you could start up your own secondary fund.
I doubt that. They are not your 2010 secondaries. Today, it's obviously a much more complex and evolving quickly market.
Yeah, and that's actually, a perfect lead in to my next question, because I think it's crazy to hear how there are now predictions out there that we're going to have another record year for secondary volume of potentially even hitting 140 billion. I think Jeffries was sort of hypothesizing we might get there for the end of the year 2024. And I think it was the Preqin Pro report that showed that there's currently 177 private equity funds in the market, targeting a combined 140 billion over the next year in fundraising. So there's no doubt that we're going to see continued growth. And I mean, that's only one asset class of private equity and 140 billion. So there's still infrastructure and private debt and all the other classes. But I guess from your perspective, working for a capital allocator, sort of traditional LP, how have you seen the secondary market evolve since your first touch points with it, as you mentioned?
Well, as you said, it's completely different. I think when you talk about secondaries, you really even have to put them in their silos, because there's so many unique opportunities to participate in secondaries that are very different from one another. So, it used to be very bespoke. Large PE investors had with large portfolios would have to sell positions either because of distress or allocations being changed or being off. And it was very hush hush. LPs were ashamed. They didn't want to talk about it. Didn't want the GPs to be mad at them. They might do a sale at a discount. I think the stigma is completely gone on secondaries, and it's an asset class that really has created many specialized transactions within it. And so today, I think LPs and GPs have accepted that secondaries are an active part of PE world and managing portfolios. And to achieve objectives today, managing your portfolio, your client's portfolios, really secondaries are an important part of doing that. And GPs, I think, have evolved with it in a way that the product offering today is just so much more complex than it was 10 or 15 years ago. And as I said, the relationships that we developed as primary investors, we used to be concerned about those when we were a secondary seller. That's really not the case anymore. I think GPs understand that there are relationships to be had and grown with secondary buyers of assets in their portfolio. And so they've been embracing that some more than others. So I'd say there's a lot of creativity in the market. It is, I think, maybe in the third inning. And so it's still early days, and the simple days are probably long behind us.
Yeah, it's interesting to see how GPs have started to also, outside of just approving transfers, right, have now evolved and are adopting this market themselves. But I guess, what are some of the challenges that both LPs and GPs face in private markets? And which of those challenges do you think secondary market provides as an effective solution?
Well, I guess to your prior point, I would say that GPs have embraced it partly as a necessity in a market where there's very few, in the last few years, sales and distributions have been low. They need to find creative ways to move some portfolio companies in funds that are getting older for various reasons. So I think they've adopted and embraced the secondary market as a way to accomplish their goals. I'd say that challenges for LPs, again, as well, wear an LP hat, is really understanding the motivations behind a lot of the GP-led secondaries. And they can be quite diverse. I think having this mindset that we don't do any continuation funds or we do all continuation funds may have worked in the early days as a simple response, really doesn't work today. because you really have to do a lot of work to understand why the GP is doing a GP-led secondary, and then determine for yourself whether or not it is the best thing for your clients to continue or to roll or to exit at the valuation that hopefully is fair for all. So I'd say that for an LP, those are the things that folks are worried about. And I was at a conference, at the Women in PE conference, and I sat in on a discussion about secondaries, and I sat next to an LP. The panel was mostly secondary investors. There were no LPs that were pure LPs. There was an LP that also had a secondary continuation vehicle that they were raising. And, she said to me, she's like, it's so hard, to even do the work. And so many continuation vehicles were coming at them. And it's so hard to really understand why they're doing it with this particular deal or these few deals. And is it really in the best interest for us as the LP? So I think that those are the challenges for LPs in today's market.
Are there any particular information provisions that an LP would expect from a GP to provide when they are considering a continuation vehicle, or something that situations where maybe you've seen yourself where a GP hasn't been fully transparent about a CV or kind of the options of rolling versus not? Anything that LPs should have like as a red flag if that particular information point is not provided?
I think that in the LPAs, they were done 3, 4, 5, 8 years ago. They don't speak to this specifically, so it's somewhat of a gray area. So you can't really go back and force that information. I think in the end, partners, limited, general, we're in a long-term partnership. These aren't for one funds. And so I think it behooves the GP to provide full disclosure about why the valuation firms that they utilized, the range of valuations, and provide the options, as you said, to exit or to roll or to stand still in some cases, if that's a good option. So I don't think that they're compelled to do so by the documents today, but I think that smart GPs are going to be full disclosure and information and give folks time, which is also an important thing because, GP may be doing one continuation vehicle. If you have a portfolio of 100 GPs, you may have 15 or 20 at the same time. So it's disingenuous to just give an LP a few weeks or, 3 weeks to get something done. So I would just say that I revert back to, you can't put everything in the four corners of a document you'd like to, but we're relying on a long-term partnership and relationship between LPs and GPs that allowed LPs to make informed decisions and that the GPs are doing things, fairly and above board.
Yeah, and I think like it's ILPA, right, that has a guideline of 30 days,
Yes.
Ideally for a CV. But to your point, I can imagine if there's 5 or even 3 simultaneous CVs going on, it's a lot of work to do in even 4 weeks to evaluate, right?
Exactly. And to be fair, these CVs aren't always single asset vehicles either. So you're trying to evaluate not just the CV, but what does the portfolio look like that's been left behind? And what does that mean for, are they going to make the hurdle? And there's a lot of complexity, I'll just say, in the motivations, and they're very different. Some are motivated by, a lot of upside, and some are motivated by protecting the fact that maybe the fund that they're in, that deal is in, is not going to clear the hurdle. So there will be no carry. So in order to crystallize carry at all, it's to take the one deal that might actually perform well, but still won't push the fund over the hurdle. So there's a lot I think that LPs have to dig in.
And then there's something to be said about, well, what's the incentive for the GP of managing out the rest of the vehicle then if they're just going to make carry on the single asset that gets done
Yep.
in the CV?
I mean, we're all human and we're all trying to do well. And so it's really hard to, nobody's a Pollyanna, whether you're a GP or an LP.
And so outside of, this is a little bit off script, but outside of providing maximum information and transparency into the transaction, is there anything else that a GP could do to make an LP's life easier when evaluating these CV deals?
I mean, I think if they would provide more detailed information on the valuations that were done, I mean, a lot of GPs do provide very detailed background on the valuation quarterly on their portfolio, meaning the bowels of the detail versus just a number and how they came up with it. I think that would be very helpful too, because otherwise we assume, oh, they must be being aggressive. Or if you know the GP, you know, oh, they're conservative typically, or they're more aggressive, or they don't move their valuations, or they do. So I think, again, just providing ultimate transparency and information. And, you know, the reality is they're not going to say, oh, I'm doing this because I am not going to make carry in this fund. But I think that LPs have to go in with not a skeptical view, but a view of, you know, open, you know, eyes wide open.
Yeah, and perhaps some of the funds that are currently being raised, there's going to be a push to change the LPAs to enact sort of more changes, right, to when there are
Yes,
CVs being done.
there has to be, I think. But the reality, I always joke that GPs are way smarter than LPs, and the GPs are always a step ahead when thinking about new and creative ways. So while that will work for the documentation in today's funds will work for what we know today, I doubt they will allow it to be broad based enough to include yet to be developed financial instruments. And so I think 5 years from now, we'll be probably talking about the same thing with the funds that did have something in the LPA, but it did not cover something that has evolved since today.
That's going to be the fun role of the legal firms to parse through that.
Yeah.
So, taking, I guess, a bit of a broader lens and thinking from an LP perspective, there's a lot of groups that are getting more comfortable with secondaries, whether it's selling their funds or whether it's continuation vehicles. But then there's also a lot of groups that have never done a secondary, right, or are very hesitant to do so. Would you consider secondaries an effective tactical portfolio management tool generally? And if so, why? Or if not, why not?
I think that they're effective, you know, strategically and tactically. I mean, tactically, you think about non-core portfolios or non-core GPs that you decide you want to prune to get access to new managers, to manage the duration of your portfolio. So there's a lot of reasons why in developing a portfolio, if you want to build it quicker, then there's a GP that you are going to support, and you backfill. We used to call it just backfill with funds that were raised 2, 3, 4, 5 years ago. I think those are really important ways to manage and build a client's portfolio. But also you might get a call from a GP who holds their LPs pretty close and tells you, well, there's one LP that wants to sell. Would you be interested in buying it? They want to curate. They want to be careful about who they have as LPs. And so you have an ability to maybe get access and double down on a fund that you maybe were cut back in allocations or something. So I think it is an important tool tactically for LPs to use in managing their portfolio and meeting their clients' needs.
Yeah, and all fronts of it, right? I guess either investing, selling, or buying. If we take the sell side perspective, there's a lot that goes into a secondary sale, and the process can be resource intensive, time consuming, right? So there's a lot of things to weigh in, whether pros and cons. If an LP is considering a sale of their private holdings, what are some of the biggest factors that should be considered?
It's interesting because I had a call from an LP who called me to just ask me, what I thought about, them doing a transaction and whether they could do it themselves and why they would do it. And I guess I told them, you have to think about their long-term and short-term objectives, why they're doing it. Think, think about managing your relationships. That's if you hire a third party, that's fine to help you manage the process, but don't outsource the management of those GP relationships, because you need to make sure that you stay close to them and they understand the whys of the transaction and that they are responsive and helpful. Make sure, obviously, you have good counsel, because good legal counsel. There's a question about doing it in-house or, having a third party sort of manage it for you. We did both. It's a lot of work to do it in-house, but you definitely are really intimately involved in shaping what portfolio that you sell, but also the portfolio that you leave and keep for your clients moving forward. The other thing I think I told him, and I think it's just to err on doing a larger transaction versus a smaller transaction. If you're going to right size, don't right size for the exact number today. Think about where you want to be in 3 years from now. You don't want to do this every year because it's just a lot of energy and time. And as you said, distraction to some, because it's not your day job. And so I think that it's important to create well received portfolio for sale and maintain a very well diversified, thoughtful portfolio for your clients going forward. When you execute on the transaction, you move forward, and it's not something that you have to revisit then every year.
Yeah, because I guess as much as, at least from an advisory standpoint, as much as we get involved and we assist with the process, the more that all parties are on the same page and everybody's sort of plugged in to try to facilitate the process, the smoother it'll go, right? So absolutely, it is resource intensive on the LP team as well, that is doing the sale, regardless, right, of whether you're doing it yourself or you're with a partner, you're distracted for a period of time until that situation gets done. Um, are there any wrong reasons to do a secondary sale for, or maybe like short-sighted, where in the long run, maybe
Hmm.
they wouldn't have done that, whether it's adhering to target allocation, maybe there's more flexibility than they originally thought. Like, is there any reason for why a secondary sale may not make sense in the long run?
Well, that's an interesting question because there's so many reasons why they do make sense. If you don't have allocation concerns or you're not overweight in a sector, because that's a reason why you do it. It has nothing to do with, I don't like this manager, but the outperformance in one particular sector could have made you way overweight in technology or something. And even if you assume for a market correction, you could still be way overweight. There's something to be said. A secondary transaction could mean three funds or one fund, or it could mean 100 positions, across 50 GPs. So I think that I don't know that there's a bad. It's just never good to do anything, I think, in life and in a secondary transaction when you feel your back is against the wall and you have no time and you have no choice. So I would say that that's why I think it's important for LPs to be thinking about this, not when they absolutely have a gun to their head and have to, but if you forecast and everybody does modeling and you see you're going to hit your allocation or bust through your allocation targets in the next year or two, you're better served to start thinking about it and do that now when you can, versus when like I said, you have a gun to your head. And at least it gives you some time to watch valuations. They're not great now. Maybe they'll improve in 6 months, but don't wait until the 11th hour to do something.
Yeah, that's an awesome point. And I can tell, from the work that we do, it oftentimes would be a year or even 2 years from the time we start a discussion and there's a monitoring phase, right, until that transaction actually makes sense. And so that's those groups kind of taking a more proactive approach and analyzing, well, what does the liquidity of my portfolio look like hypothetically? And what are my options, right? Well ahead of them needing to do something.
Yeah. And I think that even if you have advisors, you don't always, I mean, if you're negotiating directly, you can't just say, oh, here's my portfolio, because that doesn't work. You have to know what you're willing to part with and how much of that, which might not mean 100% of one fund or one GP. And it's sort of like, go fish. Do you have any more HIG? No, I do not. Okay. And so it's a process of what the buyer wants and what you want to make sure that you have left for your clients in their portfolio, but also that that you think about, if I have to get par in my portfolio, I need to hold this GP or fund that is pricing at 120 right now, and just know that that might be what you need to push you over the edge because you want to sell the portfolio on average at par. So it's a lot of moving parts, and I think it's complex. It's actually quite fun, but you have to like all that sort of Rubik's Cube kind of movement.
Yeah, I think that's changed quite a lot. Where historically, like roll back 10 years, a lot of LPs would say, well, I'm not selling my jewels. I just want to sell my kind of less preferred stuff, right? And I'm going to take a discount on it, but I'm not selling my preferred assets. Where I think now, because it's becoming so much more dynamic, groups are maybe more open to doing that and understanding the intricacies of, well, this is going to, in the long run, benefit my portfolio more if I do sell some of the better pricing funds, but it's going to pull up the overall price on the
Yeah.
deal.
Yeah. And I think optically selling at a discount is, for boards and client, is not attractive for them. And so I think again, the portfolio approach allows you to sell something at 60 cents and something else at 120 and get as close as you can to par, throw a deferral in there, throw a little secret sauce, and you can get a package that actually says, oh, it's at par or close to par, which is much more palatable for, boards and clients.
Yeah. And so I guess if an LP decides to sell, or they've been monitoring for a year, 2 years, and they finally decided to sell, how does one decide on the type of process that would be optimal to engage in, and who to partner with, and whether to run it themselves or to use an advisor? Like, what's the thought process that goes into that?
I think you have a lot of compliance issues today where you have to think about if you did a process yourself, how do you verify third-party pricing? And so you have to hire a firm for that. I mean, it's doable. It's interesting. When I spoke to this gentleman, I think just the idea of creating a transaction on his own, when I talked about, well, you need to get a third-party pricing and you need to do a model of your portfolio by sector, by vintage, by GP, you need to model what it'll look like before, what it'll look like after. It was like, oh, okay, that's a lot. And so that's where an intermediary, I think, can help. The hard part is that a lot of LPs just don't want to spend that much money. But as I said, compliance reasons, you have a lot of cover if you hire a third party that runs a process versus you trying to do it yourself. So I think they're moving away probably from doing it yourself, unless it's a 1Z or a 2Z or a 3Z portfolio, versus using a third party.
What's your take on some of the platforms that have emerged for like single fund transactions, right? Whether it be like NASDAQ private markets or Liquidly or Hive or whatever, just any transactional platforms that exist. Would you say that that is better use of resources for like a single fund, or that it's a distraction and better to kind of loop it all in and let somebody deal with it?
I mean, I think they're interesting and I think they will make sense for folks. I think there is still a personal connection, especially if you're a novice seller, to actually working with a broker or somebody that has touch points on the market. I think if you just want to sell onesie and twosie, you've done it before. I think those platforms and their funds that are actively traded, I think that there's a market price for them. I think those will work. I don't think it works for sellers that are less sophisticated and are less comfortable doing it. And it just depends on who's paying for the broker, if the buyer or the seller, and how much is that cost going to be. And I think that's an important thing that folks don't realize for LPs.
Yeah, interesting. And so taking it back a little bit, you touched on this briefly, but looking back in hindsight, what made your prior firm consider being active in secondaries, whether it be sell side or buy side generally? Was there a single catalyst that did that?
Well, we didn't do it before I presented a white paper on secondaries and why that was a good idea from a secondary fund investment perspective, and why that was a good idea during the dislocation after the global financial crisis, and that it was a good idea to actively manage the portfolio. And then, frankly, to do a structured transaction, which may bring in new primary capital as well. So I think you have to have someone that is looking outside of what their responsibilities are today. And we talk about fiduciary a lot, but, I really believe that we're fiduciaries to our clients. We have to do the best thing for them, even if it means more work for us. And I think presented with why this made sense, I think the firm decided that one, they had to be educated about what secondaries were, but then why it really made sense for the firm and for our clients.
Kudos to you for being sort of an early champion of venturing out into something less known to sort of most, right? And kind of
I guess
championing that.
I needed more hobby.
Well, look where it led you, right? So it's a phenomenal
Yes.
path in the secondary market as well. And it's crazy to think that I think it's something like 500 billion in secondary fund AUM in the market today. I think it was Prequin that cited that. And there's a lot of data out there citing that secondaries are now one of the favored strategies for allocators, sometimes even exceeding private equity in some research papers. This is maybe a little bit of a funny question, but do you foresee a world where future allocations to private markets will be just via secondary funds versus sort of primary commitments for at least a short period of time?
I do see a world where secondary allocations are potentially greater in the short term because of where we are in the market and because of the growth in potentially retail investors' involvement in private equity. And just because of duration of funds, et cetera, that makes more sense. But in the end of the day, I think GPs in private equity are still looking to buy companies, hold them for 3 to 7 years, improve them, work in concert with management. That still remains the core of what private equity is. So I don't think that will go away. But today, where we've had so much fundraising on the primary side, and you can just look at it, it's astronomically higher than it was, 10 years ago. That and the change, in the investor base potentially with, again, opening up to retail investors, I think secondaries are going to be very important, especially in that world. And so I would not be surprised that it exceeded primary fund commitments in these coming next few years.
Interesting. And there's also been some dedicated secondary funds that are just focused on GP LEDs, right? So that are going to be only focused on single asset or multi-asset GP LEDs. Do you find generally that GP LEDs are sort of an attractive way to improve returns when you're crafting an LP portfolio?
Again, I think that they're not all created equal. So if you don't have the ability to evaluate them yourself, then maybe look, I look at it as sort of like a co-investment. So if you're an active co-investor, you don't have unlimited capital, then doing a CV may be taking money out of your co-invest pocket, because essentially you're doing a single asset CV. It's kind of like doing a co-invest, but you're paying fee and carry, which you typically don't want to do on a co-invest. So, but if you don't have a team to actually review CVs, then maybe doing a fund, it makes sense because you just get access to a bunch of them. You average, the fees are lower than a primary fund and the carry. So it makes sense. I think as an active investor that's going to look at every co-invest and every CV, I think you just have to do that. The evaluation of those deals is different for every single one, not just the deal itself, but the motivations, again, behind why a CV is occurring. And so I think, again, taking off the LP hat, I think that it just takes a lot of effort to do. And again, it's no different than really evaluating a co-investment.
That's interesting perspective. I haven't heard that before. And actually, I haven't even thought about that previously, of opportunity cost of a co-investment, right? At that point, if you're doing a GP led. Pivoting a little bit. And we talked about the conflicts of interest in CVs and how there has to be disclosure and there has to be, the right alignment. But it's also interesting to see how kind of the evolution and creativity in the secondary market can sometimes normalize situations that otherwise, if kind of viewed in a vacuum, can be unfair or not in the best interest of all parties involved. And Staples is, I think, one of those situations. How do you view or navigate situations with a GP where they are requesting a staple in a sale process for either one or many of the funds, and it's obviously affecting your sale process?
Yeah, I mean, I think staples are important in a secondary transaction, frankly, for GPs, often because they're struggling. It's a difficult fundraising market, period. The cream is rising, and so the best GPs will raise capital. It will be harder, but they will raise capital. Those not so top tier GPs who maybe raised capital 5 years ago may struggle today. And you've probably read the article like everyone else. It said 10 years from now, have been a huge consolidation in PE firms, and many won't exist. I think the staple is a way for them to hopefully, in their mind, bridge the gap to when the fundraising market improves and goes back to the way it was, and they'll be able to raise capital. So I think, again, that goes to the motivations of why they're doing a transaction. Is it a negative, like, we're not going to be able to raise capital, we have to do this, and so we're going to have to part with this asset out of this fund? So there's again, different motivations. And frankly, LPs are also requesting staples. They may not have enough capital from their parent or their clients, and therefore they may ask for a staple if they sell a large portfolio, just to give them additional capital to invest so they can stay relevant to their GP. So again, I think it's important to understand the motivations behind the staple, but the reality is as an LP, you can't fall in love with the CV and not do your homework on the staple, especially if it's a GP that you're not in, and you don't have a lot of information about, because you're now not just committing to one deal, you're committing to potentially X more deals if it's a staple that isn't into just the CV, if it's into their main fund, and you're going to be tied to them for much longer. So I think it's important to again, do the homework. And you may love the deal and the CV, but if it requires a staple into a GP that you don't have long-term confidence in, then maybe that's not a CV you should be doing.
And what about if it's from a perspective of, let's say, a GP who will only allow transfer or allow buy-in from a buyer that will provide them with a staple, whereas it may drive a negative impact on the sale process of the LP. How do you handle those types of situations?
See, that's what I'm saying. I think understanding why that is a requirement, it does speak to the inability of the GP or the LP to raise capital without it. And I understand why they're doing it, but it's a difficult choice. You just have to go in, like everything, you have to go in eyes wide open. If you love the deal and you think the valuation is great and it has long-term, upside potential, or quote unquote CD short-term, upside potential, and you think that the GP has a great story, sometimes the GP has just gone through a generational transition, or they've pivoted away from a particular sector and refocused. And so that has maybe made their fundraising difficult, but they may have turned a corner. It's just been harder, and you believe, then you should make the commitment. But again, I think you have to really do your homework and understand the motivations behind the staple, understand the details of the GP. It's a lot of work. And to that end, you have to be willing to do the work.
Hearing you, I had a second thought that we're probably going to see an influx of hiring, just given the complexity of the secondary market that it's starting to take on. I just will need more hands and brains at the table.
Exactly. I mean, co-investments are, quite frankly, are easier because the company is new. It's not coming from an affiliated typically, unless it's selling it from one fund to another, but that's typically not happening. So those are more pure play. The CVs are much more complicated because of the inner workings and the motivations behind them, and add in staples and some other things. So yeah, I think that they do require certain skill set and an ability to sort of, change the way you look at things.
Yeah, it's going to be interesting to observe how that evolves and how perspectives and evolve on that front as well. Well, lastly, I guess before we wrap up this part of our chat, don't go anywhere. There's still more, but I'd love to get your take on the fact that with wider adoption in the market comes perhaps more regulation, more standardization, more complementary businesses assisting the evolution of the industry, and in turn more transparency on various sides of the market. What's your take on increased transparency on pricing, on communication, just presence of different firms at the table in the secondary market? Is it kind of a path to growth, or is it arbitrage killer? Like, what's your take on transparency in general in the market?
Again, as an LP, I think more transparency is always better. And I think transparency in pricing has improved, and some of these marketplaces have improved, knowing what's happening in the market and how fund positions, in particular fund positions, are pricing. They price probably in a tighter range, but the reality is, if somebody really desires a position or a position in a vintage or something, then they may pay above a quoted range. But I think, again, brokers and other intermediaries can often ferret out those folks that have a real interest and desire for those positions. So I think that transparency has meant that there is a band that's tighter. I still think that, again, there's just motivations. An LP really needs to backfill a particular GP or something. They may pay up for it. They won't be paying within that band. So I think that that's the easier part. I think for CVs, it's a very different process that's driven by GPs, and there's a lot of art and science in the valuations. And I think that that's where the GPs would be better served to, increase the transparency, because there is just so much, again, art in the valuation of the CV than probably there is within a fund position.
Do you think there's merit? Like sometimes I know GPs will use a third party valuation service, right? Which they can then go to their LPs and say, look, we used, I don't know, Kroll or Houlihan Lokey or whoever to value the CV. Do you think an LP may also hire their own advisory, like third party valuation service to do the same work and see if they align? Or there's just not enough time for that when they're making a decision?
No. One, there's a time. Two, it's expensive. Three, nobody knows the company as well as the GP. They're in there. They're helping with running the business and the management of the business.
Yeah.
So I'd say that's unrealistic. I think the challenge with a third party valuation firm is that they're hired by the GP. They're given information from the GP. They're probably given guidance by the GP, and they present a range of options. You know, they're not going to give you a number, and then usually the GP settles on some number within that range. So I think even if it's a half a turn here or there, it's still meaningful dollars. And so it's important for the GP to, again, be as transparent as possible and to try to provide the LPs with what is a very fair and sort of an arm's length valuation of the business.
No, that's, I think, very insightful points of view that I really haven't heard broadly in the market. So I appreciate you sharing that, Claudia, and kind of wearing your LP hat in sharing that. And so this next part of our chat, I really call the sort of bragging rights corner, where I would love to learn about some of the performance and sort of deal tidbits that you've had experience with or that you'd like to highlight. And perhaps we can start with some past sale transactions that you can speak to, or investing transactions. Doesn't have to be sale transactions. It could be primary into, secondary deals, and how they ended up performing for you.
I'd say the secondary fund positions performed okay. I mean, it was I think an 09 or 10 vintage, the one I'm thinking of. You'd think it would have performed great because valuations were low and discounts were high. It was like the perfect storm, but it's still taken a long time to exit those underlying funds. And so, IRRs were strong early, and as usual, they came down. So they'll probably revert a little better than the mean, but they're not going to be, 20+% performing bonds. On the secondary structured transactions that we did, there were ones that were done that performed very well. The jury might still be out for some of the more recent ones. I think transactions done in 21, maybe 22, and even 23 are going to be a little bit more challenged because pricing was strong and there was a fair amount of leverage on the underlying portfolio companies themselves in a rising interest rate market. And there was probably debt at the entity level for, structured around the transaction. So again, the jury may be out on that. Hopefully they perform well. I think for us, it was important to craft a strong portfolio that we believed would do well. So I think that overall they will do well. I think the buyers have been very happy. And frankly, I think soon after, I call it a 1.0 transaction was done, I was already thinking about a 2.0. And that's what I said about sort of thinking ahead, because that 5 years from now, you may, assuming your overperformance to the market, you may need to do another transaction. So I think distributions being soft and original valuation multiples being high, it's going to be tough IRRs on some of these more recent structured deals in the coming years, but I think that the MOI will be strong.
Yeah. And it raises an interesting point to where you said you want to think ahead, maybe 3 years, right? Like where will you need to position your portfolio at that point? And it may be where you're not yet seeing the strong return or kind of a return from a prior deal that you did or how it's impacted the portfolio, right? But at the same time, you just kind of have to go with your gut of what you believe is going to be best for the portfolio at some point as well.
Yeah, I mean, you have to, I think, as a portfolio manager, you have to be constantly looking at, again, sector, vintage, geography, type, is it your growth, your lower mid-market? Is it your large buyout? All the different ways of slicing and dicing your portfolio and how you want to make sure you minimize risk in a well-diversified portfolio. And again, then layer on core GPs, new ones that you add, those that you may not want to continue with. And keeping all of that in your mind, that might create a transaction down the road for you.
Yeah. Yeah, no, interesting. And taking a little bit of a different lens, you've obviously been, extremely successful in your career, whether it be operating the different businesses as the winery, as you mentioned, or in as a capital allocator. What do you think is the strength that women bring to secondaries, and maybe not just secondaries, but just private capital as a whole, and especially deal execution?
Well, it's funny. I was talking to somebody, I think at a conference, and I think I was on a panel, and I think it was a secondaries panel. And interestingly enough, there were some folks in the audience that raised their hand and asked questions, and they were saying, it was a women's conference. They were saying, well, they don't know how they can do, secondaries or do co-invest or whatever. And I told her, I said, look, I think that women's superpower in most cases is our relationship skills, our ability to relate to people, to situations, frankly, to multitask as well, to have a lot of moving parts, which I think secondaries are. And so I think multitasking, dealing with moving parts, being a closer, being able to get something done. But I really think relationship and managing a third party who might be managing your process, managing client, managing GP relationships while you're trying to do a transaction, especially a complex one, is something that, women are really quite good at. So I think that there should probably be more women in secondaries, but I think it's happening slowly but surely.
Yeah, I would agree with you. And it's so funny because almost every woman that I've asked this question have said relationship and patience and communication. And it sort of all brings it back, right, to the fact that this is a relationship based business as much as it is a,
Yep.
return and finance, but it's relationship.
And it's problem solving too. I remember at one point somebody saying, we couldn't get to a price. And they're like, forget it. We're done. We're not doing this. I'm like, no, we're doing this. Just let me figure it out. I have to, well, no, it's not going to work. I just remember a lot of naysayers. It's never going to work. And like, it can work. We just have to take this out, put this in. It's like I said, you have to have a creative mind to create something and understand who you're working with and what someone else needs and wants and what you need and want, and trying to creatively find a solution. And I think women are really good at that.
Yeah, so very not black and white, but more, let's find a gray area that we're going to make it happen here.
Right. So it's a win-win.
So
May
it's a
not
win-win.
look to what you thought it was going to look like, but in the end, it's going to be something that's good for both parties.
Yeah, yeah. No, go women. So this is likely my favorite part of the chat, that where we really get to dive in and learn more about kind of the persona behind all the market knowledge that you just shared with us. And sometimes people may not really get to see that part of you. And so I have a couple of rapid fire questions that I'm going to fire away and would love to hear your responses to them. What is your favorite asset class in private markets and why?
Well, I'm biased. I think it has to be private equity, with private credit sort of being in a second place position. I just love the idea of private equity versus the public markets. The patience that the GPs have to have in order to partner with management to transform businesses and elevate them. I love the relationships between the LPs and the GPs, even if they're sometimes at odds. They're in general, they're collaborative, they're mutually beneficial, and I just really enjoy that about the business, that that we're not thinking quarter to quarter. We're thinking long term, and growing and building businesses, which I think helps even family businesses transform generationally. It has a lot of important aspects to the market, and so I just love private equity.
It's like a little storybook, right, that you see
Yes.
develop. I'm sure that you've also had many people along the way that have inspired you or who have had a big positive influence on you. Is there any particular person that stands out that you can sort of name or give credit to in that sense?
I'd say I've been very fortunate in my, career to have met and connected with so many wonderful people in private equity, particularly certain women in private equity. I'd say Jennifer Bella McGuire, senior partner at Gibson Dunn, who reached out to me way back in 2009 at my first Women in PE conference. She just came up to me and introduced herself, invited me to a dinner. I didn't know anyone. I still stay in touch with some of those women at that dinner. She's been a mentor, friend. Honestly, she's been great legal counsel for me on secondary transactions, and it's been somebody that I've really appreciated being in my corner and being able to bounce ideas off of. I'd also say probably Carl Toma, who I first met way back when I was an associate, Green Bean. And I later worked for running one of his personal businesses. He
Wow.
taught me a lot about, working under pressure, frankly, being a person of your word and of integrity and knowing when to say when and to walk away.
It's so important to have a tribe behind you, right? And people that have sort of blazed the way before you and you can follow along. And so lastly, I think, before we wrap up this amazing conversation, I'd love to learn, what would you do if it was not finance? Like if it was an alter ego living a completely different life?
This is a tough question, but I would say I'd probably have been an architect or some sort of home landscape designer, or I'd be in the wine business. I previously ran a winery and advised people buying and selling vineyards and wineries and brands. It was an interesting combination of high tech and agriculture and low tech. And I have a fondness for the industry. I live in wine country, so that'd probably be what I do.
It's incredible. And it doesn't sound like too far of a parallel universe, because it sounds like you're in wine country and yet you're designing a new home. So you're sort of making it all come full circle.
It's also much more affordable than hiring an architect.
This is true, but also much more fulfilling, right? At the time when it's
Yeah,
done.
it is. It is. It is. You just actually think about how you use a space. And it's not that dissimilar than like crafting a portfolio. For a client, you think about what it is they need and they want. And it's the same for, building a home or, designing a landscape. How are you going to use it? How it makes sense, and, if it gives you joy.
That's amazing. Well, thank you, Claudia, for speaking with me today and sharing, a different perspective on the secondary market, one that we don't often get to hear publicly, at least. And so I'm very excited to follow your journey from here and the waves and shifts you'll drive in this industry, but maybe also other industries, given sort of the incredible volume of knowledge, influence, and experience that you bring. And thank you for being such an advocate for women in the space as well, and a mentor to both women and men, as you mentioned. Once again, everyone, this has been Claudia Baron. And thank you so much, Claudia, for joining us on the show today.
Thank you, Christina. I really appreciated it.
Awesome. And as always, guys, watch the Secondary Link LinkedIn page for updates on our next special guest. And we hope to see you in a few weeks, where we highlight the next incredible woman on the Women of Secondaries.